Imagine showing up to your job every single day. You are doing critical work, like essential work that quite literally keeps people alive.
Right.
And your boss looks you in the eye and says, you're doing great, but we are not going to give you a raise. Not this year, not next year.
Oh, man.
And that reality stretches on for almost 9 years.
The turnover in any normal industry would just be catastrophic.
Yeah.
I mean, the entire system would just collapse under the weight of inflation alone, let alone the burnout of the job.
Right.
In high-stakes fields, a natural progression in wages is like it's the only thing that keeps the workforce intact.
Exactly. And yet that is exactly what has been happening in the home healthcare sector in the state of California since July of 2018.
Wow.
We're looking at 9 years of stagnant reimbursement rates, artificially suppressing the wages of highly specialized nurses.
Yeah, it's wild.
But the data we're looking at today suggests the dam just broke. So welcome to this Talk Tickers Deep Dive. Today we are breaking down Aveanna Healthcare's Q2 2026 earnings call. For those tracking the ticker, that's AVAH.
AVH, right.
We're going to bypass the Wall Street jargon, look really closely at the underlying financial mechanics, and deliver an actionable analysis for the retail investor.
Yeah.
We are asking the core question, basically. Is this home healthcare giant a buy, a hold, or a fold?
Well, Aveanna sits at a very strange intersection right now.
How so?
So the healthcare landscape is undergoing this massive structural shift. They are operating in a space where demand is almost infinite.
Right, because of the aging population.
Exactly. We have an aging population and a growing preference for in-home care. But supply, specifically the supply of qualified, willing nurses is the ultimate bottleneck.
Yeah.
You cannot grow revenue in this sector if you cannot find the actual human beings to staff the shifts.
Which is exactly what makes their Q2 headline numbers so unusual. But let's look at the top line. Consolidated revenue was $670.5 million for the second quarter. That is a 13.7% year-over-year increase.
Which is huge.
It is.
Yeah.
And it wasn't just a revenue bump. Adjusted EBITDA hit $95.4 million, which represents an 8% jump.
Okay.
So when you see double-digit revenue growth in a labor-constrained environment, you really have to ask how a company is physically managing to staff those hours.
It requires looking at the consistency across their entire portfolio.
Right.
You rarely see every single pillar of a healthcare business firing simultaneously when nurses are this hard to come by.
Yeah, that's true.
Management has clearly figured out how to optimize their existing workforce.
Okay, let's unpack this. Let's break down those pillars to understand where this cash is actually coming from.
Sure.
Their primary engine is private duty services, or PDS. This is specialized, often like one-on-one nursing care provided to medically fragile children and adults in their homes.
Right, so think ventilators, feeding tubes, 12-hour shifts.
Exactly. Very intense care. PDS brought in $553.9 million, which is up 14%. But the figure that really stands out is their gross margin for PDS, which is sitting tightly at 28.9%.
And that margin discipline is arguably more impressive than the top line growth.
You think so?
Oh, definitely. Management had previously guided the markets to expect margins in the 26 to 28% range.
Okay.
So hitting nearly 29% means they are threading a very difficult needle.
Because they have to pay the nurses well?
Right. They are paying nurses enough to keep them from leaving for hospitals, but they are negotiating hard enough with insurance companies to maintain profitability.
Ah, I see.
They're proving that top line growth doesn't have to come at the expense of unit economics,
Yeah, that makes sense. And then we have their Home Health and Hospice division,
Right.
which brought in $69 million. That is up 14.8%.
Okay.
And their third arm, Medical Solutions. This is the logistical side, supplying things like enteral nutrition products and respiratory equipment directly to patients.
Yeah.
That hit $47.5 million, up 9.4%.
The medical solutions segment is often overlooked by retail investors.
Really? Why is that?
Well, it's just not as flashy as the nursing side, but it is a high-margin compounding machine.
Oh, wow.
Yeah, they served 95,000 unique patients this quarter in that segment alone.
95,000.
Right. And revenue per patient went up 5% to about $500. Plus, they are holding a 45.1% gross margin there.
That's massive.
It is. When you supply the actual feeding tubes to the same patients your nurses are caring for, you create a very sticky, vertically integrated ecosystem.
I mean, they're locking in the entire care process.
Exactly.
But I want to pause on the profitability metrics because the way Wall Street measures success can be deeply misleading for a turnaround play like Aveanna.
Oh, absolutely.
If a retail investor just looks at earnings per share or EPS, they might get a completely distorted picture.
Yeah, because for a company restructuring its operations, EPS is constantly muddied.
Right, by non-cash depreciation, amortization of past acquisitions, one-time accounting write-offs, all of that.
It just hides the real story.
Right. So we need to look at free cash flow.
Free cash flow is the ultimate truth teller on any balance sheet.
Yeah.
But especially in healthcare, it's the actual tangible cash left over in the bank account after paying operating expenses, capital expenditures, and interest.
It strips away all the accounting magic.
Exactly. So for the first half of 2026, Aveanna's free cash flow was $75.4 million.
And they posted operating cash flow of $85.3 million for the 6 months ending in July.
Right.
So why is that specific conversion, from operating to free cash flow so critical in the home care space?
Because billing in healthcare is just notoriously messy.
Oh, I bet.
Yeah, you are dealing with hundreds of different state Medicaid programs, federal Medicare systems, and private insurance companies.
Just a nightmare of paperwork.
Exactly. You can book all the revenue you want on an income statement, but if your back office is terrible at navigating the red tape, you never actually collect the cash.
Oh, so the revenue is just theoretical at that point.
Right. So generating over $75 million in free cash flow proves their billing and collections departments are operating just as efficiently as their clinical teams.
They are actually getting the money they are owed.
Yes.
And that efficiency is directly feeding their liquidity. They are sitting on $433 million in total liquidity right now.
That's a very comfortable cushion.
Right. That includes $97.2 million in actual cash on hand, plus access to a securitization facility and a revolver.
And for listeners who might not track corporate debt structures, those facilities are essentially massive corporate credit lines.
Yeah.
It's on a safety net they haven't even had to tap into because their organic cash generation is covering their needs.
Which is amazing. Having untouched credit lines in a fluctuating interest rate environment is a massive luxury.
Oh, it really is. It gives management the breathing room to make strategic decisions without begging the capital markets for expensive loans.
Yeah. So the numbers look undeniably strong on the surface, but a 14% jump in revenue doesn't just happen by accident.
No, definitely not.
There is a specific engine driving this, and it comes down to who is actually paying the bills. Aveanna has been very vocal about their deliberate shift toward managed care organizations, or MCOs.
And this is the operational pivot that changes the whole thesis.
Right.
Historically, a lot of healthcare billing was straightforward fee-for-service, directly with state Medicaid programs.
Okay.
But states are increasingly outsourcing the management of these Medicaid benefits to managed care organizations.
So what exactly is an MCO?
So an MCO is a private insurance entity contracted by the state to manage the delivery of health care. The state pays the MCO a set amount per patient.
Oh, I see.
And then the MCO's job is to keep that patient healthy while keeping costs down.
Okay, and Aveanna's strategy is to explicitly align their limited nursing capacity with these MCOs,
Right.
what are called preferred payers.
Yes.
They are prioritizing the payers who are willing to give them better rates. In their private duty segment, preferred payer volume just hit 64% of total MCO volume.
Which is up from 60% in the first quarter. It is a ruthless but necessary application of supply and demand.
How so?
Well, Aveanna is looking at their roster of specialized nurses and saying, we have a finite resource.
Yeah.
We are only going to deploy our nurses to the insurance companies that agree to pay a rate that allows us to compensate our staff fairly.
Which means they are actively turning down business from low-paying entities.
Exactly.
That takes a lot of discipline. If an insurance company refuses to pay a sustainable rate, Aveanna simply won't staff the case.
Right, they just walk away.
And the financial impact of this discipline is already showing up. Their private duty revenue per hour increased 1.7% to $44.62.
Okay.
That might sound like a small bump, but spread across millions of nursing hours, it drops straight to the bottom line.
Oh, for sure. And their stated goal is to get that preferred payer mix into the mid to high 80s over the next few years.
Wow, that would be huge.
Yeah, as that percentage climbs, their gross margins will theoretically widen even further. But the MCO strategy is only half of the operational pivot. The other half involves completely changing how they are reimbursed in their home health division.
Okay, so this brings us to a metric management was really eager to highlight, which is episodic mix.
Yes.
They had a stated goal to keep their episodic mix above 75%.
Right.
In Q2, they blew past that, reaching 81%.
Which is incredible.
Yeah, they processed 14,700 total episodes of care, which is an 18.5% year-over-year increase.
So we need to unpack what this actually means.
Yeah, please.
Because the distinction between fee-for-service and episodic care is basically the difference between a low-margin grind and a high-margin scalable business.
Right, so let's break that down.
So fee-for-service is exactly what it sounds like. A nurse does a visit, the company bills for a visit.
Okay.
A therapist does a session, they bill for a session. The incentive structure there is deeply flawed.
Because it just encourages more visits.
Exactly. It inherently encourages volume over efficiency. The more visits you do, the more money you make.
Regardless of whether the patient actually needs that many visits.
Right.
Okay, let's use an analogy to clarify the financial mechanics here, but apply it to the actual technology of healthcare.
Sure.
Think about hiring a contractor. If you pay a contractor hourly, which is fee for service, they will hammer one nail a day.
Right.
The longer the job takes, the more they earn.
Naturally.
But if you pay them a flat rate of $10,000 for the finished project, suddenly they are incentivized to work quickly and efficiently.
Exactly.
So episodic care is the flat rate. Aveanna receives a fixed reimbursement, currently averaging $3,202 per Medicare episode, to care for a patient over a defined period, usually 60 days.
Right, and taking that analogy a step further into actual clinical practice.
Okay.
If you're paid a flat rate, you don't just rush the job, you invest in better tools.
Right.
In a fee-for-service model, a home health company might send a nurse to manually check a patient's blood pressure every single day just to bill for 7 visits a week.
Which is so inefficient.
Exactly. But in an episodic model, where they get paid $3,200 regardless of the visit count, Aveanna will give the patient a Bluetooth-enabled blood pressure cuff.
Oh, wow.
They'll monitor them remotely from a central hub.
So the technology replaces the physical visit.
Right.
The patient gets continuous monitoring without the intrusion of daily visits.
Yeah, which patients prefer anyway.
Yeah, and Aveanna saves the enormous labor cost of sending a nurse in a car across town.
Exactly.
It is a win for the patient's privacy and comfort, and a massive win for the company's margins.
Precisely. By moving to an 81% episodic mix, they are aggressively utilizing telehealth, remote monitoring, and highly coordinated care plans.
Yeah.
Better clinical outcomes, getting the patient stable and independent quickly, actually drive better financial margins.
The incentives are finally aligned.
Yes. The ethical desire to heal the patient is finally perfectly aligned with the fiduciary duty to operate profitably.
And the proof is right there in the margins. Their home health gross margins hit 53.9% in Q2.
Which is remarkably high for a sector that has traditionally struggled with travel costs and inefficient scheduling.
Yeah, they are proving that episodic care is the blueprint for modern home health.
And it creates a predictable revenue model, too.
How so?
Well, when you know exactly how much you're getting paid per episode, you can forecast your labor costs with incredible precision.
Oh, that makes sense.
But all of these operational efficiencies, the MCO shifts, the episodic mix, they're really just the foundation.
Right.
The real growth narrative hinges on what happens when the reimbursement rates themselves actually catch up to reality.
Okay, which brings us to the most significant variable in this entire earnings call.
Yeah.
The state of California.
California is the cornerstone of their long-term thesis.
Yeah.
After 4 years of intense lobbying and advocacy from patients, families, and providers, the state government finally approved a substantial rate increase for pediatric private duty nursing.
Okay, but there's a catch. The catch is, this rate increase doesn't officially go into effect until January 1, 2027.
Yeah, and remember, this is the first time the state has raised these rates since 2018.
Wait, let's look at the risk there. The rate hike doesn't kick in until 2027.
Mm-hmm.
But I read the transcript closely, and management explicitly stated they're going to start raising their nurses' wages in California this fall, like fall of 2026.
Right, they did say that.
Isn't that a massive financial misstep? Why would a company voluntarily eat a margin contraction for an entire quarter, bleeding cash, before the state actually starts paying them the higher rates?
It seems counterintuitive, yeah.
What if California delays the January rollout?
Well, it is a calculated gamble, but it's fundamentally an aggressive market share grab.
Okay, explain that.
You have to look at the reality on the ground in California right now. Aveanna's fill rates, which is their ability to actually supply a nurse for the hours a doctor has authorized.
Right.
Those have plummeted by nearly a third over the last few years in that state.
Because the state wasn't paying enough for Aveanna to offer a competitive wage.
Exactly.
The nurses were leaving for hospitals or just leaving the profession entirely.
Right. The nurses exist, but they are sitting on the sidelines because the math just doesn't work for them.
Yeah.
So by front-running the wage hike in October or November of 2026, Aveanna intends to be the absolute first mover in a frozen market.
Oh, I see.
They are signaling to every private duty nurse in California, we are paying the 2027 rates today.
Wow.
They are going to pull the best talent away from their competitors and reactivate nurses who left the field.
So they take a deliberate short-term hit to their Q4 margins to build an army of nurses.
Yes.
They are essentially buying market share while their competitors wait for January.
And they are buying speed.
Right.
There are medically fragile children sitting in highly expensive intensive care hospital beds in California right now.
Yeah, which is tragic.
These kids are medically cleared to go home, but they can't be discharged because there are simply no home care nurses available to receive them.
Because no one can afford to work for the old rates.
Exactly. By raising wages early, Aveanna can start staffing those compliance cases in November. They can pull those patients out of hospitals early.
Which means by the time the higher reimbursement rates officially trigger on January 1st, Aveanna isn't just starting to hire.
Right.
They are already running at maximum capacity with a fully staffed, deeply loyal workforce.
Precisely.
They are investing heavily up front to ensure a massive, immediate revenue acceleration on day one.
It is a bold move, and it requires deep cash reserves to pull off.
Right. Which brings us back to that $75 million in free cash flow.
Exactly, which is why that free cash flow is so critical. They have the liquidity to absorb the temporary margin hit.
Yeah.
And management made sure to emphasize the human element of this victory, too.
Oh, definitely.
For years, parents in California have had to quit their own jobs to provide round-the-clock, high-acuity nursing care to their children because the state rates were just too low to attract professionals.
That's heartbreaking.
Yeah, and Aveanna is stepping in to finally provide relief to those families.
And, that dynamic isn't just isolated to California, though. Management noted they have successfully addressed the disconnect between state reimbursement rates and caregiver wages in all 32 states where they operate private duty services.
Right.
In fact, they secured 7 other state rate enhancements just this past quarter.
And that is a fundamental de-risking of their business model.
Yeah.
For the last few years, the entire home healthcare industry has been playing defense, just begging states to raise rates just to match baseline inflation.
Just to survive.
Right. By securing these increases across their footprint, Aveanna is shifting to offense. Moving forward, they aren't fighting for survival. They are just negotiating standard cost of living adjustments.
Right. But we can't talk about de-risking a business without looking closely at the balance sheet.
Oh, absolutely.
Specifically the debt. Retail investors often look at a company's debt load to gauge bankruptcy risk.
Sure.
Aveanna is carrying $1.48 billion in variable rate debt.
That's a big number.
It is. In a macroeconomic environment where interest rates have been volatile, carrying $1.5 billion of debt that can suddenly become more expensive sounds like a ticking time bomb.
It would be a massive red flag if the debt was unhedged.
Okay.
But their chief financial officer, Matthew Buckhalter, detailed the architecture of their debt structure.
Yeah.
Of that $1.48 billion, roughly $1.4 billion is safely hedged with interest rate caps.
Okay, let's translate how an interest rate cap actually works for a corporate entity. Because a lot of retail investors might not know.
Sure, yeah. So the majority of corporate variable rate debt is tied to a benchmark called the SOFR.
Which stands for the Secured Overnight Financing Rate.
Correct. If the SOFR goes up, your interest payments go up.
Simple enough.
An interest rate cap is essentially an insurance policy the company buys from a financial institution.
Okay.
It dictates that if the SOFR rises above a certain predetermined percentage, the financial institution covers the difference.
Oh, wow. Okay.
So Aveanna's exposure to interest rate spikes is structurally limited. Substantially, all of their debt is insulated from macro shocks.
That's incredibly smart. And they didn't just passively rely on those hedges either.
No, they didn't.
They went on the offensive with their debt this quarter. They successfully renegotiated and repriced a term loan, dropping the interest rate on that specific tranche of debt by 75 basis points.
And 75 basis points is 3/4 of a percentage point.
Right.
On hundreds of millions of dollars, that translates to massive cash savings.
Yeah.
Specifically, management noted this repricing yields $10 million in annual cash interest savings.
That is $10 million a year that goes straight to the bottom line instead of a bank's vault.
Exactly.
They can use that to fund the California wage hike, acquire new technology for their episodic care, or just pay down the principal on the debt itself.
Right.
It is exactly the kind of fundamental balance sheet tuning you want to see from a management team.
And that underlying financial confidence brings us directly to how they are projecting the future.
Yeah, let's talk about that.
With these structural wins, the MCO shifts, the episodic margins, the California catalyst, and the debt hedges, how are they guiding the market for the rest of 2026?
Oh, they are leaning in heavily. Here's where it gets really interesting. They raised their 2026 full-year guidance across the board.
Awesome.
Revenue is now projected to be greater than $2.68 billion, which is up from their previous ceiling of $2.65 billion.
Okay.
Adjusted EBITDA is pushed to greater than $365 million, up from a maximum of $342 million.
So raising near-term guidance is always a positive signal.
Yeah.
But the more vital metric for long-term investors is their updated organic growth targets.
Because that shows the actual sustainable momentum.
Exactly. They didn't just bump up the next 6 months. They raised their multi-year projections.
Right. Private duty services got bumped to a 5 to 6% long-term organic growth rate, up from their previous 3 to 5% estimate.
That's a solid jump.
And Home Health and Hospice got a massive revision, jumping from 5 to 7% all the way up to an 8 to 10% long-term growth trajectory.
You do not raise long-term organic growth targets like that unless you have absolute unshakable visibility into your future revenue streams.
Yeah, they have to be extremely confident.
Right. For home health, they cited improved federal rate stability.
Okay.
The federal government released a proposed home health rule in July and a final hospice rule in August that provided much-needed clarity for the sector.
So they basically know what they're going to get paid.
Exactly, allowing Aveanna to confidently project out for the next few years.
But organic growth is only one lever. What management is doing with their freshly generated free cash flow on the acquisition front is fascinating.
Oh, this is one of my favorite parts of the call.
Yeah, in Q2, Aveanna closed an acquisition, buying a Florida-based company called Family First Homecare.
Right.
But the mechanics of the purchase are what really matter here.
Totally.
They didn't issue new shares, which would dilute current retail investors. And they didn't take on expensive new debt.
They paid for the entire acquisition, including all the closing costs, with cash on hand.
Which is just, it's wild. That is the turning point for a company recovering from high leverage.
Yeah.
Swallowing a regional competitor whole without relying on the capital markets proves their operational engine is generating excess cash.
And it's a strategic deployment of that cash, too.
Right.
Family First Homecare bolsters their presence in a high-density senior market like Florida.
Always a good market for healthcare.
Exactly. But management also noted it expands their footprint into vital underserved rural markets like Iowa and South Dakota.
Furthermore, CEO Jeffrey Shaner actually stated explicitly that their future M&A strategy is pivoting.
Oh, really?
Yeah. While they will still execute small, tuck-in acquisitions for private duty in states where they need density, like Ohio and Kentucky, the bulk of their future capital is going to be aimed at home health and hospice.
Which aligns perfectly with the margin data we discussed earlier.
Exactly.
Home health is generating 53.9% gross margins through episodic care.
Right.
If you have excess cash to deploy, you aim it at your highest margin, fastest growing segment. It just makes sense.
And this guidance raise and aggressive M&A posture also completely diffuse a major macroeconomic fear that was hanging over the entire sector.
Oh, you mean the legislation from last year?
Yeah, last year, a piece of federal legislation known colloquially as the OBBBA was passed, which restructured certain Medicaid funding mechanisms.
Right, and the market reaction to the OBBBA was initially just panic.
Total panic.
There were widespread assumptions that any adjustments to Medicaid funding would result in immediate, devastating cuts to home healthcare providers.
Yeah.
Investors feared that state governments would slash in-home nursing budgets to balance their books.
Let's examine why that assumption was wrong, structurally.
Okay.
If a state government cuts funding for an in-home private duty nurse, the medically fragile patient doesn't suddenly get better.
No, unfortunately not.
Their care just defaults to the most expensive venue possible, which is this state-funded hospital intensive care unit.
Exactly. The states have done the math.
Right.
Cutting $1 from home health care ends up costing the state $10 in hospital admissions down the line.
It's a terrible trade-off.
Yeah, and management confirmed on this call that private duty nursing is essentially insulated from those OB/BBA cuts.
Okay, that's good to know.
The states view home care not as an optional luxury, but as critical cost-saving infrastructure.
Wow.
So Aveanna isn't just surviving the new legislative environment, they are actually expanding within it.
And this confidence culminates in their most ambitious financial target, which is structural deleveraging.
Yes.
Management is now actively projecting a timeline to get their net leverage ratio down below 3x.
Which is a huge milestone. For a retail investor, a sub-3x leverage ratio is the dividing line between two completely different types of investments.
Also,
Well, above 3x, a healthcare company is often viewed as a highly leveraged, speculative turnaround play, vulnerable to credit shocks. Right, it's risky.
exactly. But below 3x, the market begins to reprice the stock as a stable, cash-generating compounding machine.
Oh, I see.
Achieving that sub-3x goal will likely unlock an entirely new class of institutional investors who are currently barred from buying the stock due to strict debt mandates.
Because their funds won't let them buy anything too highly leveraged.
Exactly.
So, which brings us to the ultimate synthesis of this deep dive. We've looked at the margin discipline, the episodic technology shifts, the California strategy, and the debt structuring.
We've covered a lot.
Yeah, it's time to deliver the signal for the retail investor. So what does this all mean? Is AVAH a buy, hold, or fold based on this Q2 data?
Well, when you aggregate the operational execution, specifically their ability to drive double-digit growth while holding strict margin targets in a massive labor shortage,
Right.
and you pair that with massive macroeconomic tailwinds like the California rate hike,
Yeah.
it is incredibly difficult to take anything but a highly bullish stance on their fundamental trajectory. I agree. The data totally supports a strong bullish thesis. If you hold or are considering AVAH, the core takeaway is that the foundation has been repaired.
Yeah, it's fixed.
They aren't just chasing top-line revenue with unsustainable spending. They are locking in 29% margins in their main business, 54% in home health, and capping their interest rate exposure.
The California rate hike alone provides a multi-year visibility runway that very few companies possess.
That's a rare advantage.
When you have a massive market that has been artificially suppressed for almost a decade finally unfreezing, the incoming revenue influx is highly predictable.
Right.
But their most powerful asset is really their negotiating leverage with managed care organizations.
Let's put concrete numbers to that leverage, because this is why the MCO strategy is working so well.
Okay.
Aveanna is offering a 10x savings to the entire healthcare ecosystem.
10x.
10x? Management laid out the stark reality on the call. It costs an insurance company or a state Medicaid program between $6,000 and $7,000 a day to keep a medically fragile child in a hospital and ICU. Aveanna can provide elite one-on-one nursing care for that exact same child in the comfort of their own home for $600 to $700 a day.
I mean, that math is the ultimate competitive moat.
It really is.
When your service saves the payer 90% on their highest acuity patients, you aren't treated like a replaceable vendor anymore.
No.
You become essential infrastructure.
Yeah.
You gain immense pricing power because the payers are desperate to keep those patients out of the $7,000 a day hospital beds.
So to distill all of this into a single, actionable investment thesis for our listeners,
Let's hear it.
AVAH is a cash-generating turnaround play successfully escaping a decade of stagnant state reimbursement rates. They have the free cash flow to acquire competitors outright without dilution, the operational discipline to hit target margins via episodic technology, and a structural 10x cost advantage that the broader healthcare system simply cannot ignore.
They've navigated the toughest macro environment possible, honestly.
Yeah, they really have.
They fixed the labor rate disconnect across their national footprint, and now they are shifting from defense, just trying to catch up to inflation, to pure offense,
Yay.
expanding market share through early wage hikes and driving telehealth efficiency.
Which brings us to a final thought for this deep dive. Something for you to mull over as you analyze this sector. A concept that extends far beyond a single ticker symbol.
Okay.
We just broke down how Aveanna is proving that high-level, complex medical care can be delivered in a home for a fraction of the cost, often with much better outcomes because the patient is shielded from hospital-acquired infections and kept in a comfortable environment.
It forces us to fundamentally rethink the physical geography of healthcare.
Exactly. Taking that to its logical conclusion, with companies perfecting the logistics of remote monitoring, episodic telehealth, and decentralized nursing,
Yeah.
are we witnessing the beginning of the end for the massive centralized hospital?
Wow.
If the technology continues to scale, will the hospital of the future even be a building? In 10 years, will your own living room be the primary intensive care unit?
It's a profound shift in capital allocation, if you think about it.
Right.
Instead of building billion-dollar hospital towers, society might just be outfitting millions of bedrooms with enterprise-grade medical tech.
A completely decentralized healthcare grid.
Yeah.
It is an infrastructure revolution hiding in plain sight right within these earnings calls. So keep digging into the data, and we will catch you on the next deep dive.